The key risks for Chinese banks over the next 12 months are liquidity and capital pressures resulting from regulatory scrutiny. Credit growth has decelerated, but absolute debt leverage is still rising. Tight regulations on shadow and interbank activities are consuming more bank capital and create a drag on profitability. These challenges underpin our negative sector outlook for 2018. The sector has seen a fast rise in loan-to-deposit ratios over 2017. In particular, household leverage has increased quickly, and there's evidence of consumer loans having been used to support home purchases. This is an area of increasing concern to regulators.
In terms of the risks to Chinese growth in 2018, we think on the domestic front, the housing market is going to be crucial. Housing sales have started falling on a year-on-year basis. In the past, we've seen a very close correlation between China's housing cycle and the broader industrial sector. This is all happening in China as credit conditions are gradually tightening, interest rates have been rising, house purchase restrictions have been increased. We think that process is going to be gradual, but if it's more dramatic, that could have a big impact on growth. On the external side, I think the key to watch is the dollar. The fact that capital outflows in China decreased in the second half of 2017 had a lot to do with the broader weakening of the dollar in global FX markets. If that dollar trend were to reverse, we could see renewed capital outflows and renewed complications in policy management in China.
For Chinese corporates, the key risks to look out for over the next 12 months are whether corporate profit growth and the deleveraging trend can sustain as the property market continues to cool off. The current property cycle has been a long one, but we expect property sales growth to slow down in 2018 as the government's austerity measures remain in place and inventory levels in Tier 3 and lower tier cities increase. This will likely weaken demand for upstream commodities as well as for downstream housing-driven sectors.
The key risk for Chinese local government financing vehicles in the next 12 months is the uncertainty of government support for the less important LGFVs. While local and regional governments' backing for major borrowings vehicle remains intact, there is rising concern about the timeliness of support on less important LGFVs amid pressure from national authorities to enforce market discipline and reduce moral hazard. In the past year, we have observed sector consolidation of LGFVs in several local governments in China. The small LGFVs with less strategically important government roles are likely to be sidelined and consolidated in an effort to reform the sector.
The state banks are likely to play bigger roles in providing liquidity to smaller banks, as funding conditions should remain tight. Margin pressures are also likely to weigh on net profit growth, which we expect will remain in the low single digits in 2018, even with little change in reported asset quality, given continued debt write-offs and non-performing loan disposals. The migration of assets onto banks' balance sheets would accelerate risk-weighted asset growth, but this should also improve transparency and help to contain financial risk. Fitch might consider revising the banking sector outlook if efforts aimed at promoting deleveraging are successful and sustained. This may benefit the viability ratings for some state banks, as they have proven more resilient than other commercial banks to tighter regulations.
Where Chinese corporates are concerned, the opportunities for growth include sectors that fit well with the economy's shift towards a better quality growth model, including but not limited to high-end manufacturing, renewable energy, healthcare, education, internet and technology, and various mid to high-end consumer segments.